Mutual funds. What are mutual funds? Mutual funds let you pool your money with other investors to mutually buy stocks, bonds, and other investments. They're run by professional money managers who decide which securities to buy stocks, bonds, and when to sell them. You get exposure to all the investments in the fund and any income they generate. They offer a wide variety of investment strategies and styles. Why invest in mutual funds? Mutual funds are very popular within the US and nearly half of the households own mutual funds. Some of the reasons include diversification. Mutual funds give you an efficient way to diversify your portfolio without having to select individual stocks or bonds, since they cover most major asset classes and sectors. Low cost. Some brokers offer core mutual funds with no investment minimums. Some allow you to buy and sell mutual fund shares without incurring loads or transaction fees. Convenience. Brokers allow you to reinvest dividends and capital gains distributions. Professional management. Fund managers do the research for you. They research and select securities and monitor the fund's performance. How do you typically earn a return from a mutual fund? You can earn a return from mutual funds by dividends and interest. A fund may earn income from dividends on stocks or interest on bonds, which is passed along to its shareholders minus any expenses. Capital gain distributions. Most funds pass along these gains, minus any capital losses, to investors at the end of the year. Fund share price increase. If the fund's securities increase in price during the time you own the fund and the manager holds onto them, the fund's shares increase in value. You can then sell your fund shares for a profit. How do I choose? Identify your investment goals. What are you looking for? Growth? Income? Liquidity? The answers will determine the kinds of funds you consider. Consider expenses. All else being equal, consider mutual funds with lower expenses. Fund expenses add up over time and can significantly impact your long-term returns. Keep taxes in mind. Consider the fund's tax efficiency and whether you're going to hold it in a tax-advantaged account like your 401k or not. What's the difference between active and index funds? There are differences between these funds, but they are really two sides of the same investing coin, and many investors use both types in their portfolios. Actively managed funds. These are funds with portfolio managers that select investments that seek to outperform a benchmark. The pros of actively managed funds are opportunity for outperformance. As active funds aim to beat an index, they typically offer you the potential to make higher returns than benchmarks. Defensive measures. Managers have the ability to respond tactically to market opportunities. In other words, active managers can respond actively to changing market environments. Tax management. Active managers typically try to buy low and sell high, which can generate taxable gains. Some managers, however, also aim to harvest losses to minimize taxable distributions. The cons of actively managed funds are expensive. Fees are generally higher due to frequent buying and selling, managerial salaries, and research costs. Active risk. While active managers are usually trying to choose investments to earn high returns, there is a risk that they will choose poorly, which can hurt the fund's performance. Underperformance. On average, actively managed funds have historically performed worse than their benchmarks over long time periods. While some funds have outperformed, most have not. 2. Index funds. These are funds where managers aim to mimic a specific index, replicating its holdings and performance. The pros of index funds are low fees. Managerial oversight is generally less expensive, since managers are mostly mimicking what's already in the index. Transparency. Since index funds aim to track published indexes, which typically don't change frequently, it's usually clear what the fund likely holds at any time by looking at the index. Tax efficiency. An index fund's typical buy and hold strategy doesn't usually generate large capital gains taxes. The cons of index funds are lack of flexibility. Managers are usually restricted to a specific index or predetermined set of investments, no matter what happens in the market. Performance constraints. By definition, passive funds will rarely, if ever, beat the index they are tracking. No downside protection. In a down market, the fund's return will potentially be as bad as the index it tracks. What are some types of funds? Equity funds. These funds invest in U.S. or foreign stocks. Some are index funds, while others are actively managed. Typically, they're defined by the size of the companies they invest in: small cap, mid cap, or large cap, or their investment objective, growth, income, etc. Fixed income funds. These funds buy investments that pay a fixed rate of return, like government bonds and investment-grade corporate bonds. They may give your portfolio the chance to earn income. Asset allocation funds. These funds will allocate a specific amount to fixed income and equities depending on the fund's goal. They typically offer income and growth potential in one fund. Index funds. These funds comprise a portfolio of securities that attempt to mimic the performance of a specific index, such as the S&P 500 index. They offer a low-cost, straightforward way to track an index that's generally more tax-efficient than actively managed funds. Target date funds. A type of asset allocation fund where the mix of securities and asset classes, equities and fixed income, gradually shift as your target date for needing the money, usually for retirement, draws near. Money market funds. These funds generally invest in cash equivalents such as U.S. Treasury bills and CDs. They're lower-risk investments and tend to offer better returns than savings accounts, but they are not insured by the FDIC. Thank you for watching.